Hey guys, welcome back to my channel. This is Devin. I want to thank you for stopping back by. In this video today, I am going to address a comment I got on my YouTube a couple days ago. And this video is basically going to be about that comment, illustrating how the infinite banking concept can be used. So here's the comment. Can you make a video going over numbers if someone wants to put in a lot of money all at once, paying in chunks, versus a smaller amount monthly? Thanks. So guys, a lot of times what I do with these videos is I'll illustrate someone putting in a smaller amount of money so it's more relatable. Not everyone can just dump in large sums of money. So in this video, I'm going to show you guys an illustration of someone dumping in a bunch of money and how that is really beneficial when it comes to infinite banking. The more you put in up front, the better it is, and for a lot of reasons. So I'm going to show you an illustration, and then I'm going to go over exactly why doing it this way is like the best way to do infinite banking, and then how you can actually use that concept, use that policy in real life. So let's jump into it. So here's our illustration on our guy that can put in a whole bunch of money to start his policy. His name is Al, a lot of dollars. That's his name. He's 40 years old, he's healthy. We're just doing a standard health rating. So if it was a better health rating, the policy would be better. If his health wasn't as good, it wouldn't be as good. So just run of the mill, standard health. What he's able to do on this policy is year one, putting in $200,000. So when you have a policy, you have your premiums, and they're cut up in between two things. With an infinite banking policy, you have a base premium. That's like your off-the-shelf whole life insurance. And then you have PUAs. That's paid up additions. That's you overfunding that regular whole life policy. That's what gets all the cash value. It gets a little bit of death benefit, but a whole bunch of cash value. You can only do that so much. So you can only put so much PUAs on a base premium in order for it to stay non-taxable. If you put too much, it becomes taxable. So what we're doing with this kind of policy is we're front loading the PUAs into the first year, as much as we can into that first year. Reason why that is really beneficial is the younger you are, the longer your money has to grow. So if you can put 200 grand into a policy that's guaranteed to compound and grow tax-free every year, it's going to become a really big number the younger you are, the sooner you do that in your life. So if you dump money in right at the beginning, it's incredible. You can only do this one time. So you dump money into the policy when you start it. You guys could see up here, it's $180,000. That's the dump in amount. That's how much a lot of dollars is dumping into his policy. That's all PUAs. Paid up additions are about 94% liquid. So that 180 grand, a lot of dollars has access to about 94% of them right away. The difference between the 180 and the 200 is his annual premium, 20 grand. Of that 20 grand, some of it's PUA, some of it's base. So basically what we're doing, again, is we're front loading the PUAs, getting them a whole bunch of liquidity in the policy. As you can see, 200 grand goes in. Look at the cash value that year, 185,000 bucks. So he puts in 200, he can use 185 for whatever he wants when it comes to infinite banking. And the beauty of it is, because he got so much in there year one, so much was compounding from day one, the policy is really efficient very early. Meaning when he puts $1 in, he can use $1 or more. Check this out. Year two, puts in 20 grand, cash value grows by 23. So he puts in 20, yet he can use 23 grand more. That means that it is already efficient in year two because of the dump in. Year three puts in 20, it grows by almost 25. Year four puts in 20, it grows by about 28. Year 5 puts in 20. I mean, you guys can see it just keeps getting better and better and better. And then the death benefit starts off really high because he's putting a bunch in. So this is an example, an illustration of someone putting in a bunch of money up front. The dump in amount dictates the annual premium. So the higher that amount is that he's putting in right away, the higher this annual amount has to be in order to support it as a life insurance policy. If this was 200, but this amount was like 5 grand, that wouldn't work. It would be too much PUAs going into the policy to begin the policy on that small of an annual premium. It'd just be too much. It would become what's called a modified endowment contract, which basically just means it's taxable. You don't want that. You want this to stay tax-free. So this is like finding that fine line. That's the most we can get in year 1 based on the annual premiums being 20 grand. If the annual premiums were 40 grand, we could probably get about 400 into the policy year 1. If they were 100 grand, we could get about $1 million into the policy year 1. So it's really cool. The higher that first initial year, the higher the annual amount has to be, which is a good thing. That's just more money going into the policy, and you can do more things the higher the cash value goes. So now you guys see how it's designed, why it's beneficial. Let's go ahead and take a look at how you can use this policy in your life for infinite banking. So if you've got money sitting around and you could dump something in like this, check out how beneficial it is. So now that you guys know how a policy can be designed to have a dump in, a bunch of money going in right away to start compounding for the rest of your life, bunch of liquidity, let me show you how to use that in real life. So a lot of dollars had 200 grand that he put into a policy. That money could have come from anywhere. Could have been in some sort of account that wasn't giving him a lot of growth. It could have been in cash. It could have been from a line of credit on his house. There's a lot of different ways that you can fund a policy like that. But let's just say, for easy understanding, let's say it just came from his regular savings account. Puts 200 grand into the policy. Now it's protected against lawsuits and judgments in most states. So that 200 grand is actually safer in the policy than really anywhere else. It's a private contract between you and the insurance company. So it's safer there, can't be touched on lawsuits and judgments. It's guaranteed to grow tax-free. And with dividends, with these companies that we use, generally speaking, you're getting around 5 to 6% growth. So let's just throw that in here. 5 to 6% is what that is going to make, that 200 grand now with dividends, while it's protected from lawsuits and judgments. So since a lot of dollars had access to $185,000 that first year, let's say he takes a policy loan to pay off his bad debt. Let's say he's got $150,000 in bad debt. What I mean by bad debt, it's debt that's not paying you. You've got bad debt and good debt. A bad debt is like a car. If that car does not bring money into your pocket, it's a bad debt if you have a car loan on it, because then it's just money leaving your pocket and leaving you and your family forever. So good debt, you can have debt on, let's say, a credit card, and that credit card, you used it to go do an investment. If it's bringing money into your pocket, it's a good debt. Let's just say a lot of dollars has $150,000 in bad debt. He's going to take a policy loan, pay that bad debt off. When you take a policy loan from a policy, there's no questions asked. There's no financial statements. There's no credit checks. If you have cash value, you can take a policy loan whenever you want for whatever you want. He's going to take it to pay off this bad debt. Let's say this bad debt has payments monthly of about $4,000. I'm just giving arbitrary numbers so you guys can understand the concept. $4,000 is what he used to pay every month to these creditors. Every single month, $4,000 would leave him and his family forever. He'll never get that $4,000 back. So if he pays off the debt with his policy, all he has to do to practice infinite banking is take that same amount of money he used to pay to the bad debt and pay it back to his policy by paying down the policy loan. So now what he's essentially doing, he's getting all of the money back. The 150 grand, he'll eventually get it all back into his policy, plus the interest he used to pay on the bad debt, because that 4,000 is principal and interest. So he's getting what he used to give away. And it's not about how much you make, it's about how much you can keep. This is a way to keep more of your money because you control that policy loan. You can pay it back or you cannot pay it back. If you pay it back, 4,000 bucks goes in, you got access to that $4,000 again right away. You can use it for whatever you want. So let's take a look at what's going to happen in this situation. A lot of dollars. He's got his second year of his policy coming up. He's going to be able to put in 20,000 bucks. Boom. That's how much he can put into the policy. $20,000 in year 2. Remember what I showed you guys. Cash value went up by about 23,000, a little bit more than 23,000. And what he was doing for the entire year is he was paying himself $4,000 a month back to his policy that he used to pay on all that bad debt. So very simple math, guys. This comes out to $48,000 that he's paid back into his policy. He has access to all of this money right away. He can use it for whatever he wants, whenever he wants. Now, he's paid back 48 grand. He's got access to that. His cash value went up by 23. He's got access to that. But remember, he still had an additional $35,000 in cash value in his policy. Because remember, he had bad debt of 150. But his policy, when he put in 200, he had access to about 185. He only used 150. So he's got 35 grand that he did not use. He paid back in 48 grand. That's money he used to lose forever. It's not extra money. It's just money he used to give away. He's now getting it back into his policy. Plus, he put in another 20 grand. Cash value went up by 23. So essentially, this next year, he's got access to, what's that? 60, 71. He's got access to $106,000. Hopefully I did that math right off the top of my head. If I didn't, in the comments, let me know. So he's got $106,000 inside of his policy that he can use in year 2. So let's say he doesn't have any debt anymore, right? He paid off all of his bad debt. He's just recapturing all of it every month. $4,000 every single month that he's recapturing. So what's he going to do this next year? Let's jump into that, how he can actually use the concept on a bigger level than just paying off his debt. Okay, so a lot of dollars, has his debt paid off. He's got this money in his policy, $106,000 that he can use for whatever he wants. Let's say he's going to go be a private lender. This is one of the most passive ways to invest in real estate. You take your money and you lend it to someone doing a real estate transaction. You secure your position by a lien position on the property. So you have protection, and then you're getting a rate of return on your money. I'll just give an example of what I do. I lend at 15%. So let's say if a lot of dollars took his 106,000 and lent it at 15%, that would be $15,900 he would make in 1 year. Remember, he's recapturing the $4,000 he used to give away. So that's $48,000 for the year. And then the $20,000 he's putting into his policy this year, it grows by 25. That's how much his policy grows in year 3. So that altogether, guys, is $88,900. He's got that much more that he could use as a private lender. So if you look at going into the next year, he's now got lent out almost $195,000 at 15%. That's going to make him $29,235 in a year's time. He's still recapturing the money he used to give away, 48 grand. He puts 20 grand into his policy in this year, and it grows by about 26, a little over 26. So now he's got 103,235 that he can add to that number as a private lender. So do you see how this just keeps getting bigger and bigger and bigger? And the bigger the numbers of what you put in, the bigger the result with the growth and what you can do with the money. This is why, guys, I have 15 policies and why I'm putting in nearly $1 million a year into infinite banking policies. If this is how the policy is structured, 200 grand going in, 20 grand a year, you cannot put more than that. If you do, it becomes taxable. That's why you have to start having multiple policies so that you're not having to pay Uncle Sam. So hopefully you guys got a bunch of value from this video. Not everyone can do this. Not everyone can dump money into a policy. But if you can, it makes so much sense. Even if you can only dump in 30 grand, 20 grand, you have to keep in mind that when you do that, you have access to most of it right away because it's paid up additions. So if you want to take a look at this, what this can look like in your life, check out the description in this video. There's a free training video. Register for that video. Watch it till the end. Write down your questions, and you'll be able to schedule a call. That way, me and my team, we can help put together a scenario like this for you and show you how you can use it. So do that now. Check out the description in this video. Go ahead and register for that video. Watch it till the end and schedule your call. If you have not liked this video already, make sure to do that. And if you liked this video, you're going to love that one. Check that one out. Until next time, I love all you guys. Peace.